This is Andrew Stotz of Stotz Investment Research looking at Singapore, which has cheap valuation and low risk as of today, the 14th of December. Let's look at the 4 points that I'm going to look at in this presentation. The first one is the 4 pillars of GDP. So first of all, what we can see is that overall growth was slow at about 1.7% over the last 4 quarters. This was driven by net exports. Typically, Singapore is a net exporter. It's become the major driver from a negative contribution as of second quarter. The laggard was investment, which went to have a large contract instead of being a driver as it was in second quarter. Private consumption, just a zero, so almost no impact there as far as contribution is concerned. Such an externally driven country tends to have much more impact from investments and net exports than from consumption. So if we look at the overall country, the first thing we can see is that there's been a little bit of a recovery going on in the Singapore market after a long decline relative to the rest of Asia. The country has 6 million people, and market cap or GDP is about 300 billion. GDP per capita is about 52 or 53,000 US dollars per year, which is pretty amazing. And market cap of the stock market is about 537 billion US dollars. Average daily volume is about 700 million US dollars, and there's about 700 companies listed on the stock market. Valuation is cheap, relatively cheap, due to relatively weak fundamentals. ROE is about 8%. Only Taiwan offers a higher dividend yield than Singapore, so about 4% here. If we look at the FVMR ranking of the country, we can see overall it's moderate at number 7. So fundamentals are poor, ROE is below 10%, but valuations are attractive and dividend yield is high. Momentum, poor earnings momentum, but we can see from the chart previously that price momentum is increasing and is moderate. And finally, risk, well, low volatility and relatively low beta relative to the rest of Asia. Let's look at the market structure and the sector performance here. First of all, the market structure shows that industrials are 26% of the market, real estate 22%, and financials 19%. The best sector in stock, well, energy was up 21%, Ezion Holdings was up 43%, and the worst sector was telecoms, down 7%, and M1 Limited was down 21%. That wraps it up for Singapore. To get access to additional research and articles, join our free newsletter at becomeabetterinvestor.net/join, and I'll see you there.